welcome everyone to today's version of Value Talk. We have with us Puneet. Puneet and I go way back to MDI days. We are alums from MDI Gurgaon. Besides, Puneet has been in the equity space for quite some time. I'll just read out his profile for everyone's benefit. So he as of now is a CIO, oblique a fund manager with Stoic Investment Managers, wherein he is into investment advisory and providing equity advisory and asset allocation solutions to his clients. Before this, he has worked with two India-focused hedge funds on the equity research desk. So he's very well qualified in terms of providing you uh, inputs about being an equity investment professional. He is also a charter holder of a CFA, MDA alumni, and presently he is a visiting finance faculty to MDI Gurgaon, a very interesting subject he teaches, which is behavioral finance and business valuation. This particular subject was earlier taken by another professor who's a very famous professor, Professor Sanjay Bakshi, and now Puneet, Professor Sanjay Bakshi has moved on, and Puneet is in place teaching that subject to second year final semester or alumni, final semester students of MDI Gurgaon. And besides that, he specializes in evidence-based investing. We have done some earlier talks also with Puneet, which are available on our YouTube channel. Today, it's about balance sheets, as to what balance sheets are, and the major focus would be as to how businesses at times kind of try to fudge balance sheets to for various reasons. Could be from outright fraud to just getting better valuations for their shares. And also, what are the areas where sometimes there is hidden value which is missed by regular investors, which if a balance sheet is gleaned properly, can be found in the balance sheet. So with this background, I'll welcome Puneet on the talk today.
Thank you so much.
Yeah, my first question would be, would you just provide a very basic definition of balance sheet and its importance in equity investments?
Okay, I'll presume two things here before I even start. Okay, one is that we are talking about balance sheet in the common parlance. What I mean by that is, majority of the time when we talk about financial statements, the short way of saying that is balance sheet, because balance sheet in itself is just one of the statements which which the business presents, besides the profit and loss account and the cash flow statement. So when we say balance sheet, ideally when we're talking about the financial statements, we generally talk financial statements together, balance sheet being one of the major ones. As far as what it is, I'll come back to that, but why is it important is very simple. Ultimately, when you make an equity investment decision, unless your investment decision is based on something other than the business itself. Okay, so for example, it could be price movement, so you could be doing a momentum based investing. You could be a technical chart driven investor. If you're doing any of those stuff, pretty much you're not looking at the business but the ticker itself. There it's a different matter. But if you are investing like a businessman and you're looking like the whole philosophy of buying businesses and buying good companies over a long period to create wealth, there you are evaluating a business. Now, as far as evaluation of the business is concerned, there are two approaches people take. One, you talk about क्या product बेचता है, क्या market कहाँ पे है, कौन सा customer है, etc., etc., etc. That is the broad understanding of what the company does. But eventually, whatever it does will be visible and will be finally noted down in those financial statements. So you cannot evaluate a business unless you can evaluate the financial statements, because otherwise everything is just plain simple narrative. So if somebody comes and say, I have great customer base and I can grow dramatically, and I have a huge scalability, I have huge pricing power, and I have a very good I'm a very well capitalized business, etc., etc. All these are talks unless and until we can see that in those financial statements. So, so without that, you can't evaluate a business. That is the importance of it. Now, let me come to the first part of your question, which is what exactly is balance sheet? Now, just talking about balance sheet in itself, it is
What you are essentially saying is that the financial statements will give us कि ये अंग्रेजी के आगे जो है the actual worth of a business. Otherwise, I can keep on talking whatever English I wish to.
yeah, it will tell you what is happening in the business. It will not tell you the worth of the business that you have to do yourself. You have to calculate yourself, but it will give you all the necessary information that you need to be able to do that work.
Mhm. Okay, yeah, go ahead, please.
Okay, so now let's just talk about the statements in themselves. Okay, so balance sheet and profit and loss, they go hand in hand. Now, what is the difference between the two? Balance sheet is at any given point in time. If I say, what is this company? What does this company own? Understand that company as an entity in itself doesn't own anything. It's it's a paper on which you have mentioned that okay, this is a company, right? It doesn't have its own money. Whatever money it has, it belongs to somebody, and wherever it is using that money, that also is not companies per se. I hope that part is clear, right? So balance sheet at any point in time says that this is a company which have taken money in X form and have deployed money in Y assets. Okay, broadly. So this at any point you can say this is where the money has come from, this is where the money has been deployed, and all the times this has to balance because at the end of the day, whatever is taken, it can only be deployed. Not extra can be deployed, not less can be deployed. If less is deployed, it will show as a balance cash. Okay, so this is some. I mean, I'm talking very layman here, but any point you look at the company, you will get a picture of how much the company has taken from sources and where all it is deployed. That is balance sheet. Now, when you move from one point in time to another point in time, so let's say we talked about the general talk is 1st April of any year to 31st March of that year, financial year, right? So if I move from 1st April 2021 to 31st March 2022, so if I have created a balance sheet on 31st March 2021, that is telling me what was the statement, what was the situation of the company on that particular date, 31st March. And then one whole year will go and the company will again prepare the same snapshot of the company called the balance sheet. And it will now tell you what is the situation on 31st March 2022. And whatever has happened in between will be captured by P&L statement broadly. Okay, there can be some write-offs here and there from the balance sheet itself, but I mean, from a layman perspective, everything that happens between the two time is being captured by the P&L statement. So in one way, P&L is the journey, and balance sheet is the starting and the ending point of the it's the starting and the ending point of the journey.
Okay. For the ease of the audience, just to help you understand what Puneet is essentially saying is that let's say we start a fresh company today, and you as an equity holder invest 100 rupees into it. At the end of so your asset today is the 100 rupee cash you have in hand, and the liability is the 100 rupees you have to return to the equity investor who has put in that 100 rupees. And at the end of the year, you have a business wherein you have generated, let's say, 20% profit. So now the cash in hand, and assuming that entire money has come back to you. The cash in hand and everything, it's now 120 rupees. So your balance sheet has a 20% increase because of the 20% profit. So now the after the business, if it assumes that it has to return that 100 rupees in equity to the equity holder, the business has a 20 rupees asset on its book.
Yeah. So more or less what you're talking about is how the whole thing gets balanced. So
Yeah.
I can maybe detail a bit more before we go further, right? So
Sure.
when we say how the company has sourced money, okay, that talks about the liabilities of the company. So usually there are two sources of capital primarily. One is the debt capital, which is loans, etc., which is taken by the company, and the second is the equity capital. So whenever you see one side of the balance sheet, which is where the money has been sourced, it shows the liability side of the balance sheet. Uh, Post 2012, some changes have happened, but let's talk very basic of the balance sheet. Now, on this side, you generally see the debt component and the equity capital, and that is why this whole side is called liabilities and equity capital. Okay. Uh, if somebody knows, they will also know that current liabilities also come here, but I'm not taking that into consideration right now. Okay. Now, when this money is taken, that is being deployed into assets. So when you look at the asset side, that money is basically, so let's say you have taken 100 rupees. Let's say 80 came from equity and 20 came from debt. That 100 rupees you have deployed into physical assets. Okay. Now, it could be physical assets. Let's say you bought 60 rupees ka machine. And let's say 40 rupees is currently lying in your hand as cash in bank. So that is how the balance sheet will look when you have started the business. Now
Right.
imagine that you have used this 60 rupees worth of asset and you created some stuff out of it. Why would you buy the machine? Because let's say an ice cream parlor, you bought the machine, now you're making ice creams. So when you sell the ice creams, eventually on this whole activity of selling ice cream, you will make some profit. So at the end of the year, the profit which you will make will go and get added back to the shareholder equity or the owner's capital, which was 80 rupees earlier. So let's say you made 10 rupees profit, that will go and add to that shareholder equity number. And eventually both sides will get balanced for this very reason, because the extra money will also go in cash in your, I mean, very, very layman, right? So there will be changes, depreciation, etc. But broadly, this is how the whole thing happens. So one point, second point, and in between the complete changes are captured by P&L statement.
Awesome. So now my second question is that, after this kind of basic understanding that this is balance sheet is from where we start, and then the P&L or the profit and loss account will give you the idea as to how the business has done over a period of 1 year, or if it is a continuous process in 2 year and 3 year, etc., and how
Yeah.
the balance sheet has moved accordingly. Uh, how often do businesses engage in cooking their books or balance sheet manipulation?
How often? Okay. That will be very presumptuous on my part to say how often they do. I can
Okay,
only say that they
but they
do,
do.
right? So yeah.
They do.
So to say that, okay, first of all, let's understand what exactly this whole thing means, right? Cooking the books. Uh,
Mhm.
in the whole example that I told you, I said that you have 60 rupees ka assets on which you sold some ice cream, and on that ice cream you made some 10 rupees ka profit. Okay. Now, when I am evaluating this company, I'm looking at the 10 rupees profit and I'm thinking in my mind how this 10 rupees will grow over a period of time, and how much will this convert into cash and come back to me, etc., etc. And I'm doing this to value the business. Okay. Now,
Yeah.
if I am now as a promoter, if I know that, and let's imagine the normal promoter of our country owns 60-70% in the company. Okay. And
Mhm.
he wants here, my share should be valued very high. So there are incentives for that guy to show you more than 10, or to show the number which might not be reflecting the true picture of the business. So that 10 could be an overstated number, or sometimes they will, instead of 10, show 15 or 18 by doing some manipulation. So one manipulation is generally to show higher profits. There is a flip side. I mean, there's the other side also. Most of the private companies, they do the other side of things. They don't want to show profits because they would want to pay as less tax as possible, because they are not
Mhm.
publicly valued, and hence they want to hide so many things and they want to show less profit so that they can give less tax to the uh, exchequer. So, so this is the broad reason why people do manipulation. But besides that, there are other reasons also. So, for example, you have to raise money. Okay. Now you raise money by showing either a very rosy picture about your business, or you can also show great assets. Maybe your asset was 60 rupees, but instead of 60, you are showing 80. And you're going to the bank and say, कि यार ये मेरा asset जो है 80 का है, मेरे को इस पे 60 का loan दे दो. Right. So basically, in that sense, also some people manipulate the value of the assets to get better value for their assets, so to speak. So I mean, there are many reasons why people do manipulation. The most uh, what do you say, bang for the buck for the cheating promoter is when he is able to manipulate the business in such a way that the share values are goes very high, and then he's able to cash on to that, right? So let's say, and most of the companies in our country, a lot of shares are not only in the promoter holdings, which we see in the balance sheet, but also in some other entities which are not shown as promoters. So many times promoter, they sell shares, but you will never see that they are selling shares because they're selling from entities which are not shown as promoters. So there are many ways in which cheating promoters, they actually take advantage of shenanigans. But the major reason हमेशा same रहता है कि you want to show better value for your company. Primary reason, which was the case with Enron or Satyam, or any of those. Satyam was a different ballgame altogether, but major aim is that only, that you keep on showing better picture than what exists in reality.
So you keep on showing better pictures so that your shares are valued. I mean, the company shares are valued at a price which is not a true reflection of your business, and you can then offload your shares in the market and get, I mean, get the
Yeah,
price which is
yeah.
not.
I mean, see, sometimes it's just a matter of ego also, right? Many people, when they fall in that trap, they don't want to stop that because they want to have that great aura about having a big business, great valuation, etc., etc. I have seen people who kept on holding to their shares. The whole thing went up, market got the hint, the whole thing went down also, they never cashed out also. So, but yeah, I mean, even though cashing out might be one of the aim, but it is sometimes people just do it for pure ego also. They get caught in the trap.
So how do they typically overvalue these assets? The way you said that, I mean, would it be that I mean, asset valuation is going to be a more market objective thing, isn't it?
No, so asset valuations, overvaluation is actually, it's not market, right? So the whole thing says that you either value it lower of cost, okay, or the current value, so to speak, or market value. Now, in majority of the
Mm.
cases, the market value is fidgety. You don't really get that number. Think of fixed assets primarily. Okay, uh,
Mm.
there it's the cost. So if you have to show higher numbers, okay, there you will have to manipulate the cost element only. You bought an asset for 100 crores, you're actually showing that you bought it for 120 crores. Okay, if you have to do
So
asset
typically
valuation. I'm sorry.
over invoicing from.
Yeah, there are many ways they do that, but yeah, that is one of the ways, right? So that is physical assets. Majority of the time, you see things happening on the current asset side. So in current
Mm.
assets, you have your receivables, you have your inventory, and you have other assets like loans and advances, etc. Okay. Now, imagine that. Uh, I mean, inventory overvaluation can be very easy to see in, let's say, case of real estate, right? Now, let's say you are owning a huge set of inventory, and let's say that the whole project is gone for a toss. Actually, if you look at the market value and the cost, you should ideally reduce the value of the inventory. But the promoter will say, ki, nahi yaar, the value is higher, so I will take the cost as my inventory valuation. I, okay, so that way you're showing more value of your inventory. This can happen in manufacturing companies also. You can show much more valuation in the inventory side. The second part is the receivable side. Maybe your receivables are not really good receivables, but you have given a lot of stuff on credit, and you're not going to get that money back, but you're not really discounting those. You're not writing off those receivables. So you see higher receivable numbers. I'm giving you all these pictures when you're talking about overvaluation of the assets. Okay, but the purpose of actually doing this is much stringent, because when you have to reduce the value of the assets, you also have to reduce the profits, because that reduction goes via PNL. Okay, so your PNL gets, so people can see that, okay, now you're at your inventory or you're adjusting your receivables. That means your receivables are not very trustworthy, so to speak. So whenever promoter does these kind of things, market will always doubt them कि यार ये जो number दिखा रहे हैं इसमें कुछ genuineness भी है कि नहीं. If you do it more frequently, let's say you are the promoter of a company, and every second year, third year, you are uh, making some extra provision for receivables. Market will come and say, how can you keep on continuously making these errors? One time we can understand, two time we can understand, but if you continuously do it, it's a problem. Okay, so then there's a doubt in the mind of the market also that, okay, whether the numbers are even believable or not. Same with inventory. So generally they don't fudge around too much. They constantly just keep on doing it and adding it. That is overvaluation of the assets. right? Uh,
Okay.
but
I'll interrupt you here. So,
yeah,
just for the sake of explaining to the audience, what Puneet is saying is that in a balance sheet, how typically a asset is valued is at the cost basis. Say from the example of real estate, I am a company which has a real estate project और मुझे प्रोजेक्ट बनाने के लिए 400 करोड़ का खर्चा हुआ और मैं उसको कॉस्ट प्लस बेसिस की मैं उसको 25% मुनाफे पे बेचूंगा ये करके मैंने उसको 500 करोड़ पे अपनी इन्वेंट्री में दिखा दी. It is highly possible that my the market does not even support 400 CR sale price because there has been a correction in the market or it is oversupplied. But I do not make that change in my balance sheet. So an outside person who is looking to invest in my company as an equity shareholder, he feels that my assets are 500 crore worth of rupees as an inventory. Similarly, this can happen in any other manufacturing or some similar industry where inventory is held. And वो जब account receivable की बात कर रहे थे, तो what he was saying is that the money you are supposed to receive. Now, at times you make sales and you're waiting for money to come in, but that money can get delayed, one, or it may not come at all. But and you are at times aware कि ये मेरा मुझे शायद ये पेमेंट नहीं मिलेगा 5% 10% जो मैंने सामान बेचा है, but you don't declare it again, or you keep on moving with it and करते रहते हैं. So this is how uh, businesses can at times manipulate the balance sheet. Please, Puneet, go
yeah.
ahead.
So on the asset side, just another very most common example is that when you have investments on your book, okay, you made investments, the diminution in the value of those investments, if it happens, especially when you've taken a strategic stake in some other company, and that, let's say, that company's business is completely down or it is completely losing its value, the company might not decide to diminish the value of that particular investment and not show it on the books. So that way you're overstating the assets. Majority of the time, overvaluation of the assets is an outcome of P&L activities, but that's how it is. I mean, there are many other ways you create fictitious reserves and many other things, but for the most common ones, these are the ones which you have discussed.
Hmm. Hmm. Okay, and how are liabilities undervalued?
So, okay, again, liability is undervalued primarily. There are many people, what they do is, let's say you have an expense, okay, and that expense is leading to a liability. Sometimes
Hmm.
can uh, not acknowledging that can actually understate your liability. Uh, but many times, the more common one is that if you have a commitment or a contingent liability, okay, and you're not showing that contingent liability. In many companies, what the most common thing we see is that liability से इतना कोई ज़्यादा नहीं खेलता है, but commitment or commitments जो होती हैं, capital commitments, which is basically you're already committed that you're going to incur that expense, but you don't want to show it right now as a commitment. Ideally, you are supposed to. Similarly, there are certain contingent liabilities. कहीं पे कोई taxation का कुछ चल रहा है, कहीं पे कोई payment जो liability अभी तक बनी नहीं है, but बनने के बहुत chances हैं, and it's a significant amount. Again, the companies are supposed to report this, but some companies they decide कि नहीं यार ये नहीं दिखाते, ठीक है? मिलती है बाद में कहीं पे market में information मिलती है, that's a separate thing, but they decide not to show it on the books. So that is the more common one. That not showing contingent liabilities or capital commitments is a very, very prominent way in which people try to fool the investors, so to speak. But you have to
What are
recognize
the
the
other
majority. Yeah.
what are the other common manipulation
Manipulation.
practices? You don't need to
The
name a
majority of the
business,
time,
but
see, I understand majority of the times, manipulation usually start with the P&L. What they do
Mhm.
is that they start overshowing the revenues, inflating the revenues, or they start manipulating the expense.
So
Okay.
either
So
they'll increase the revenue
yeah, they will show more
or they
revenues
will
than what
reduce
they are.
the.
Yes. But these are the majority of these are the most common ones.
Okay. And what about the shareholder equity manipulation? Say, am I creating entities which are not, which are kind of, I've transferred my shares for on private placement prior to bringing the company to public, or with the express intention that at some point in time I'll manipulate the prices and offload those shares. How common is that?
Extremely. I mean, there's no answer to how common, right? People
Okay.
who are absolutely clean. So the way I think about this is many times you would not even get to know this. But what you do, how do you get to know this? You get to know if there is any problem in the financial statements, you assume the worst, that things which are not also visible might be there. And if the things are cleaner on the financial statement side, you assume that everything else is also clean. Okay, so majority of the time things will be visible on the financial statements. What you need to be more cautious of are the manipulation that happens on the either the balance sheet or the cash flow statement. And generally, these two manipulations are the one which we look for. See, P&L manipulation have a way of reversing themselves. Again, I don't want to complicate stuff, but when you just fudge the P&L and one or two times, you can always go back, recognize those expenses you did later on and so on and so forth. So sometimes people do this to and fro between one and so क्या करते हैं, एक पीरियड का ज्यादा दिखाने के लिए एक पीरियड से बोरो किया, दूसरे में दिखा दिया, फिर अगले साल जो बोरो किया था उसको वापस भी कर दिया एक तरीके से, right? So P&L manipulations are that way is much easier to manage. The difficult ones to manage are the balance sheet ones, because once you create, it becomes sort of a place that there's a cash, Satyam did with the cash account. Okay, they just get this empty box जहाँ पे जो आपने पाप किया सब डाल दो, ठीक है, और वो जब इतना बड़ा हो जाता है तब वो फट जाता है. So balance sheet को जो no fraud that happens on the balance sheet can, and for a substantial period of time, can go unburst, so to speak. It has to burst at one point in time. Whereas P&L frauds can reverse much easily. Not to say that you should give leeway to those companies. I'm just trying to tell you that frauds are also not same. So sometimes they're done just for the sake of, जैसे मैंने आपको बताया revenue recognition में, fake invoices. Rico was one company which was caught for this. They created fake invoices. Now that could be a structural problem also. You can keep on creating because आपको एक तरीका मिल गया है, तो आपने करते रहे जब तक कि अब आप फेक इनवॉइस दिखाओगे तो क्या होएगा, पैसा तो आपको मिलेगा नहीं, प्रॉफिट बढ़ता जाएगा. सो यू आर कॉन्स्टेंटली शोइंग प्रॉफिट्स बट यू आर ऑल्सो कॉन्स्टेंटली गेटिंग रिसीवेबल्स. तो या तो आप दिखाओगे कि यार मेरे को पैसा मिला नहीं वापस, सो यू विल शो इट एज रिसीवेबल, या आप और भी झूठ बोलोगे, आप बोलोगे रिसीवेबल नहीं है, मेरे को पैसा मिल गया, एंड दैट यू विल शो इन कैश. ओके, नाउ यू से हाउ कैन यू शो कैश? कैश तो बैंक में दिख जाना चाहिए, but there have been cases when even the statements which get verified by the accountants are also fudged, कि बैंक अकाउंट का स्टेटमेंट ही fudged है. Okay, so those kind of manipulations, over a period of time they become, it's easy to find. So how do you, the more important question is कि ये सब हो रहा है तो पता कैसे चलेगा, right? So for everything there is an equal and some reaction is happening on some side of the balance sheet or financial P&L और cash flow. तो आपको ये देखना है कि इस पर्टिकुलर चीज के साथ क्या एक दूसरा एलिमेंट होएगा जो इफेक्ट हो रहेगा, एंड डज इट मेक सेंस और नॉट. Okay, so I'll give you an example. Actually, one of the most common ways of how do you start finding of, let's say, a shenanigan, right? आप एक बिजनेस कर रहे हैं, तो एक बिजनेस में आप जनरली कुछ एक साल के एंड में एक प्रॉफिट बनाते हैं, right? When you make that profit, there is a cash flow statement which talks about a number called CFO, which is cash flow from operations. Okay, so in profit and loss statement, आप रेवेन्यू में से अपना खर्चा माइनस करके जो आपका एक एबिटा का नंबर आता है, that number should effectively be equal to your cash flow from operations number. एक टैक्स का कंपोनेंट और है, so actually it is एबिटा माइनस टैक्स, वो मैच करना चाहिए. अगर किसी कंपनी में मैच नहीं कर रहा, तो generally it is because the company is also loading upon, it is screwing up a balance sheet कि inventories बढ़ रही होंगी, receivables बढ़ रहे होंगे, so there is some reduction in cash, because in P&L you are saying मेरे को 100 रुपए का रेवेन्यू आया, बट टेक्निकली अगर आपको 80 रुपए का आएगा तो आप 20 रुपए का रिसीवेबल दिखाओगे, तो आपका रिसीवेबल बढ़ता जाएगा, तो आपको उसको माइनस करना पड़ेगा अपने कैश फ्लो स्टेटमेंट में से. सो अगर आपने एक बार माइनस किया, आपने 20 रुपए माइनस कर दिए, तो आपका CFO कम हो जाएगा, आपका P&L में एबिटा माइनस टैक्स का जो नंबर है वो बढ़ता दिखेगा, मगर ये 20 रुपए आपको वापस आना चाहिए ना अगले साल. तो अगर
Correct.
आपको ये नंबर बढ़ता जा रहा है कॉन्टिन्यूसली, तो आपका सीएफओ और एबिटा माइनस टैक्स जो है वो कभी भी आपस में कन्वर्ज नहीं कर रहा, वो बढ़ता ही जा रहा है गैप हमेशा किसी रीजन से. दैट मीन्स देर इज सम काइंड ऑफ मैनिपुलेशन हैपनिंग ऑन द बैलेंस शीट.
Either
टिपिकली
manipulation or very poor business practices. You are selling too
नो,
much on credit and
या तो अगर आप क्रेडिट में वो कर भी रहे हैं तो एक टाइम के बाद आपको उसको राइट ऑफ करना पड़ेगा ना.
correct.
अगर आप रिसीवेबल्स दिखा रहे हैं कॉन्टिन्यूसली एंड दे आर कॉन्टिन्यूसली इंक्रीजिंग, दैट कुड आल्सो बी बैड बिजनेस, यू आर राइट, दैट कुड बी रियली रियली पुअर business running. But at the
Right.
after a point you will say ना कि अच्छा यार this is now a 3-year receivable, my receivable cycle is 3 months, तो मैं इसको राइट
Correct.
ऑफ
So
तो लूंगा कभी ना
accounting
कभी.
तो नहीं आपको करना ही सेटल करना ही पड़ेगा. And the moment you do an accounting write-off, then you are liable to explain as to why it was
Not
carried
only
on for
liability,
such.
it will get visible again,
Yeah.
because it will reduce your P&L, it will go via the P&L statement, तो आपका प्रॉफिट कम हो जाएगा. तो एक साल कभी ना कभी, दैट इज व्हाई वी नेवर लुक एट 1 year नंबर. तो अगर आप लेट्स से सीएफओ देख रहे हैं और एबिटा माइनस टैक्स देख रहे हैं और वो रेशियो देख रहे हैं, तो आप एक साल का नंबर कभी भी देखेंगे तो मिसमैच हो सकता है. बट इफ लेट्स से यू आर लुकिंग एट क्यूमुलेटिव 5-year numbers, and then there also you're looking at the trend of that number. Okay, that number should not be very very low. If that number is consistently very low, that means CFO number is constantly coming much lower than EBITDA minus tax on the P&L. That means your balance sheet is getting somewhere, it is getting bloated. Okay, so that's then it's a matter of finding where it is. So that is the first starting point when we start in finding shenanigans. It's an easier one, but yeah, that is one. You have a question?
I will have a last question. While there are a lot of ways by which companies would try to, bloat the balance sheet or get an exaggerated evaluation, are there also situations where companies are, they keep on sitting on assets and the assets are undervalued and they are not really reflected in the balance sheet? And I'll
Yes.
come from an example. So I think around 10 odd years ago, Borosil was sitting on one of its plant, and its P was at around 3 odd something, and but the price by book value was, the ratio was very very skewed. In the sense, they were making an operating loss, a very minuscule operating loss, and then but their the plant was an old plant, and then they eventually sold that old plant for hundreds of crores of rupees. So how do you are there hidden jewels wherein a careful glean of the balance sheet can tell you that this is where they are sitting on too many assets and unlock the value?
So इसको मैं hidden jewels नहीं बोलूंगा. The reason for that is there are many companies. I mean, especially in our country, majority of the companies, they bought their lands long back at extremely cheap valuations. So if you take them on market value today, it will be like 100x value of those assets. Many such lands. अभी तो फिर भी now the market values have to be taken and a lot of things have changed. But पहले ये बहुत होता था जब land की value revalue नहीं होती थी. Right? Revalue means it was not required to do that. Now it is important to show those numbers more realistically. So पहले क्या होता था कि these stories were very common. For example, Scott's only, it's a Faridabad based, there were many lands they had in Faridabad. And the constant story was that what you see on the books in terms of the land asset and the actual market value, there is a huge difference. Okay. But land is, chalo, theek hai, land is not, I'll ask you a question. Okay. आपने ये land देखा और you are a minority shareholder, जैसे retail shareholder, and you want to buy the company. Would that land make any difference to you? If that land is there, but that land is not adding anything to the profits of the company. Like now, what you're saying is, it is not really adding, but it might add in future. कभी तो कुछ करेंगे, कभी लैंड बेचेंगे, या तो लैंड बेचेंगे या उस लैंड को यूटिलाइज करेंगे. Right? Now that is where the market tends to assume a lot of things. So a good management, let's say you are let's say the company market knows that it's a very good management and they will not misutilize an asset. Us case mein, market will assume that the whole thing will get utilized well and the market will start giving its value. तो जो आप hidden gems की बात बता रहे हो वो वहां पे होता है जहां पे मार्केट को ट्रस्ट है कि ये जो एसेट्स हैं ये किसी ना किसी फॉर्म में एज अर्निंग्स इक्विटी होल्डर को मिलेंगे. बट कई जगहों पे मार्केट को ये ट्रस्ट नहीं होता है. Right? There maybe the management does not have the history. Maybe the management has not communicated anything. एग्जाम्पल है नेस्को का. नेस्को बहुत जो बॉम्बे एग्जीबिशन सेंटर चलाती है जो कंपनी, उसके पास लैंड हुआ करता था घाटकोपर में शायद, इफ आई एम नॉट रॉन्ग. वो लैंड बहुत वैल्यूएबल था. मुंबई है, इतना बड़ा लैंड है, तो बहुत वैल्यू थी उस लैंड की. उस वैल्यू, अगर मैं लैंड की वैल्यू ले लूँ तो पूरी कंपनी उस लैंड की वैल्यू से कम पे मिलती थी मार्केट में. ऐसा ऐसा सिचुएशन था. बट मार्केट नेवर गेव इट वैल्यू. जब मैनेजमेंट ने ये बोला कि अब हम यहाँ पे आईटी पार्क बनाएंगे, और फिर वो आईटी पार्क बना और वहां से अर्निंग्स आनी शुरू हुई, तो उस इनकम स्ट्रीम को मार्केट ने वैल्यू दी, और तब that value realization happened. So not all the assets which you see or may be hidden will get realized, is what I'm trying to say. There might be hidden value, but that value also has to realize in form of share price increase. That might happen or might not happen depending on case to case basis. Sometimes market don't even trust cash on the books. Classic example was MTNL. MTNL at one point in time had more cash on the books than the whole complete company ka valuation. Think of it, I mean, realistically, it's like you go to a restaurant और आप रेस्टोरेंट वाले को बोल रहे हो कि तेरे गल्ले में जितना पैसा है, उससे कम पैसे में तेरा मैं पूरा रेस्टोरेंट खरीदूंगा, including this गल्ला. I mean, practically this is not feasible, right? You can't buy the whole business plus the cash for less than that amount. But market sometimes gives you that opportunity. Now, why it is happening? You might think ये तो stupidity है, but it's not really stupidity. Why? Because the market is saying कि cash आज दिख रहा है, मगर ये मेरे पास कभी आएगा नहीं. Because this cash will go into bad assets, which will make losses, etc., etc., etc. So not every hidden asset or visible asset will get realized in its value. So we have to be careful about that part.
So to understand the MTNL example, the way market probably was thinking was कि जब तक ये कैश मुझे मिले उससे पहले their operating losses are so high that वो वैसे कैश खत्म हो जाएगा.
हाँ, तो अगर या तो MTNL ये बोल दे कि यार ये कैश जो है मैं इसको अपने एसेट्स में यूज नहीं करूंगा, ठीक है, और मैं शेयर होल्डर को डिविडेंड की फॉर्म में दे दूंगी. जिस दिन, अगर ऐसा कभी हुआ नहीं, बट लेट्स से MTNL अगर ये अनाउंसमेंट कर देती, तो उसी दिन उस कैश की वैल्यू उस स्टॉक के प्राइस में रिफ्लेक्ट हो जाती. ठीक है, मगर जब तक वो वैल्यू रियलाइजेशन होगी कि नहीं होगी वो डाउट है, तब तक मार्केट विल नॉट गिव इट द वैल्यू. In some companies they will. For example, in Piramal case, the company eventually did give value. But in MTNL, it never got the value because market knew that this cash will dissipate away. And majority of the time, they are right about these kind of assumptions. Very few cases where they are wrong. Those become the opportunities.
Fine. So just to conclude about that discussion, what Puneet has essentially said is that there are three major components of financial statements of a business: the balance sheet, the profit and loss statement, and the cash flow statements. Now, in half an hour, 40 minutes discussion is too insufficient to kind of cover the intricacies of all these three statements. But if you are looking to be a equity investor, then you should try and read these statements over a longer period for a company, last 5 years, 10 years. See if there are any inconsistencies. And those inconsistencies or those basic mathematical inconsistencies should raise those red flags to you that this is not a company I would like to put my money in. There is something which I am not able to put a finger on, but there is something which is not exactly in sync with the established accounting or business practices, and my interests would be safeguarded if I stay away from these kind of companies as a retail equity investor.
You gotta focus on yourself, on your faith, on your dreams, on your mind, on your health, yeah. You gotta work now.